I'm going to discuss the topic is called foreign currency translation. Foreign currency translation, commonly known as accounting disclosure, arises because financial statements of foreign affiliates which are stated in a foreign currency must be restarted in parent company's reporting currency to prepare consolidated financial statements. Foreign currency translation, commonly known as accounting disclosure, arises because financial statements of foreign affiliates which are stated in a foreign currency must be restarted in parent company's reporting currency to prepare consolidated financial statements. Foreign currency translation. To consolidated statement, the following must be consolidated: language, accounting concepts, and currency. Why should be included in consolidated statement? Narrow view and wide view. A narrow view consolidated statement should include the parent firm and all domestic subsidiaries. Wide view. All subsidiaries regardless of location should be consolidated. Foreign currency translation. Why currency translation needed? Many companies having subsidiary companies in other countries. Different countries having different accounting rules. Why currency translation needed? Many companies. Translation method. Example: suppose you had 100 British pounds on deposit in a London bank at the end of 1993 when the exchange rate is $1.80. To report the deposit on your 1994 balance sheet dollars, you would translate the deposit at the current rate and you would report an asset at $180. At the end of the 1994, you still have the 100 pounds in a bank, but now the exchange rate is $1.70. To report the deposit on your 1994 balance sheet, it would now translate into $170, and you would have imbalance of $10 to deal with. If you translated at the historical rate, you would still translate into $180 and there would be no imbalance. If you translated at the historical exchange rates, current rate, exchange rate prevailing as of the financial statement date. Historical rate, exchange rate prevailing when a foreign currency asset was first acquired or a foreign currency liability was first incurred. Average rate, a simple or weighted average of either current or historical exchange rates. Two major issues which exchange rate should be used to translate foreign currency balances to domestic currency. How should translate gain on losses be accounted for? Should they be included in income? Translation methods may employ a single rate or multiple rates. Two main translation methods: current and non-current method, monetary and non-monetary method, temporal method, and current rate method. Translation models. Current and non-current model. Current items on the balance sheet are translated at the current rate. Long-term items on the balance sheet are translated at the historical rate. This method of foreign currency translation was generally accepted in United States from the 1930s to 1975. COGS is translated at the current rate. It is based on inventory, a current asset. Depreciation is translated at the appropriate historical rate based on the date of acquisition of the asset. Under this method, a foreign subsidiary with current assets in excess of current liability which causes a translation gain if the local currency appreciates. Monetary and non-monetary methods. All monetary balance sheet accounts, cash marketable securities, account receivable, note payable, accounts payable, etc. of foreign subsidiary are translated at the current exchange rate. All other non-monetary balance sheet accounts, owner's equity, fixed assets, long-term investments and inventories are translated at the historical exchange rate in effect when the account was first recorded. Temporal method. The underlying principle is that assets and liabilities should be translated based on how they are carried on the firm's books. Balance sheet accounts are translated at the current exchange rate if they are carried on the books at their current value. Items that are carried on the books at the historical cost are translated at the historical exchange rate. In the effect at the item, the firm placed the items on the books. Current rate method. All balance sheet items are translated at the current exchange rate. A very simple method is application. A plug equity account named cumulative translation adjustment is used to make the balance sheet balance. Translation, gain or loss do not go through the income statement according to the method. Current rate